Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome to the Trending Report, your monthly commentary series designed to help advisors and investors make sense of today's market in an attempt to stay focused on what really matters, long-term success. I'm Tyler Krzciok with USA Financial, and in this episode, we're going to take a look back at what happened in 2025, highlight what sectors drove the S&P 500 growth, along with some of the worst performing thematic trends. Then we're going to go ahead and turn the page to 2026, focus on the indicators that you should be watching and which sectors might have the most opportunity, along with taking a look at what some of the top advisors are seeing and doing right now. So let's take a dive into 2025 and what happened. It was a year that demonstrated real resilience amid multiple headwinds, rising interest rates earlier in the year, new trade tariffs caused a market shock in April, and the longest government shutdown in U.S. history happened towards the end of the year, as well as a cooling of the labor market overall. While all that was going on, the U.S. stock market boomed. S&P 500, NASDAQ, and Dow all posted double-digit gains and achieved all-time highs. As a whole, S&P 500 total return was up about 18%. And it's not really surprising that tech companies like Western Digital, Micron, and Seagate are leading that charge. Some sectors soared, while others hit some turbulence. 2025 saw great success in the communication services and information technology sectors, mainly focused on the heavy investments and development into AI technology. Utility stocks also benefited from the steady electricity demand, partially driven by the power-hungry AI data centers and EV charging stations. Alongside stocks, other notable gains came from commodities, as they had a remarkable year. In particular, precious metals skyrocketed. You saw the price of gold rise over 64%, and silver even spiked at 141% as well. Now let's take a look at what didn't work in 2025. The 5 worst performing themes of the year were mobile payments, master limited partnerships or MLPs, India consumer, India tech, and Bitcoin. Mobile payments have been riding high coming out of the 2020 pandemic, fueled by the shift to digital transactions. But starting a few years back and definitely into 2025, that story changed. Rising interest rates have squeezed growth stocks and competition has intensified. Suddenly, the valuations that once seemed justified look really stretched, and investors pulled back. And the sector dropped hard, down over 40% by the end of the year. MLPs have fallen out of favor as oil prices have stayed choppy and regulatory uncertainties loomed. India consumer and tech were also hit hard by tightening global liquidity and rising competition around the world. Investors also rotated out of emerging markets amid geopolitical concerns. Growth slowed, and that theme underperformed. Finally, Bitcoin. Crypto had its moments in 2025, but ended less spectacular than other years. Regulatory crackdowns and the waning enthusiasm for speculative assets really pushed Bitcoin lower. That was 2025, a year that reminded us that markets can be unpredictable and themes or trends can fall out of favor fast. That's why short-term emotions can severely impact long-term plans. So what does 2026 have in store? The consensus view is that the bull market will continue, although maybe not into the double-digit returns that we've seen in previous years. They may be cut down to single-digit. Why? Well, a mix of easier financial conditions, tax adjustments, and a renewed push in business investment, especially in technology. Companies aren't just dipping their toes into AI anymore, they're diving headfirst. That means capital is flowing into automation, data analytics, and infrastructure to support this next wave of innovation. Consumers are also expected to play their part. Spending should get a boost early in the year, and that's good news for sectors tied to lifestyle and discretionary purchases. So where do the opportunities lie for 2026? Technology is still the headline. AI and automation aren't slowing down. Healthcare and biotech, though, those remain strong as aging populations and personalized medicine drive demand. And definitely don't overlook industrial and infrastructure. The modernization projects and easing financial conditions are making that space look attractive. Finally, consumer discretion could see a surprise if confidence rebounds. Bottom line, 2026 is not about chasing yesterday's winners. It's about positioning for tomorrow's trends. Let's shift gears now and talk about what advisors are seeing as we step into 2026. Because while headlines tell one story, the conversations happening in client meetings often tell another. One big trend, advisors are doubling down on education. I don't mean going back to college. The focus is on educating the clients about their plan and the why behind the investment. After a volatile 2025, clients want clarity. They're asking more questions about risk management and how to stay disciplined when the markets are choppy. Advisors are responding by leaning into that planning conversation and not just having performance updates. We're also seeing renewed interest in diversification, not just across asset classes, but across strategies. Formulaic investing is gaining traction because it takes the guesswork out of timing and emotions. Advisors have said, clients want to know that there's a plan and that plan does not change every time that the market hiccups. Another trend, thematic investing is still popular, but advisors are being more selective. Instead of chasing the hottest trend or the highest return, they're asking, does this theme fit into my disciplined long-term approach? And that's a huge mindset change from the past years of chasing return and what's the hottest stock currently. Bottom line, advisors are focused on helping clients stay calm, stay diversified, and stay committed to the process. Because in a world full of noise, clarity is the ultimate value that you bring as a trusted advisor. So what's the big takeaways from all this? Stock market goes up, the stock market goes down. Trends will always shift, but your success doesn't have to hinge on predicting every twist and turn. The real edge comes from discipline, not emotion. That's where formulaic investing shines. It's about having a rules-based approach that keeps you focused when the noise gets loud. Instead of reacting to the headline or chasing yesterday's winners, you're following a process designed to adapt and keep you on track towards long-term goals. As an advisor, that's the beauty of the exchange platform. It gives you access to a variety of money managers, each with their own formulaic strategies and approach. That means that you can diversify not just across asset classes, but across growth, value, trend following, risk management, stock-based. It's like building a team of specialists for your portfolio. Different portions of your assets can follow different trends without losing sight of the bigger picture. Because at the end of the day, investing isn't about guessing, it's about planning. And when you combine clarity, discipline, and the right tools, you set yourself up for success no matter what the market throws your way. Thanks for tuning in to the Trending Report. Stay informed, stay disciplined, and let's make 2026 a year of smart decisions.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.